Hello, welcome to the European Open briefing for Friday, February the 2nd. I'm Rafi Barajan, currency analyst at XM.com, and we're going to be taking a look at what's happening in the currency markets today. The US dollar is faring a little bit better this morning. It is being helped by soaring treasury yields. But that's mainly versus the Japanese yen. It is actually mixed versus other currencies. It's down versus the euro and the pound. Both the euro and the pound enjoyed another leg up yesterday, moving towards last week's highs. The yen has come under pressure this morning after the Bank of Japan stepped in the bond markets again to push down the yields on Japanese government bonds. The main losers this morning are the Australian and New Zealand dollars. Both currencies have come under pressure on declining yield spreads with the US. Let's start then with the dollar. We can see the dollar index in orange here in the chart. It hasn't really made much progress since that 3-year low last week. It's actually dipped back below the 89 level, having climbed above it yesterday. It's currently trading around 88.70. In purple, we can see the yield on 10-year Treasury notes, which reached a near 4-year high of 2.797% earlier. Rather late yesterday. Yesterday we did have some decent data as well. Fourth quarter labor costs came in much stronger than expected, and the ISM manufacturing PMI also beat the forecasts. The main focus then will be the non-farm payrolls report for January. That's due later today. It's going to be interesting to see whether or not it has much impact on the dollar. The main data point that could potentially have the most impact is wage growth figures. We did see a slight pickup last month, and if that continues this month, and on top of that, the Fed's hawkish statement we had on Wednesday, that could help the dollar cover further ground, extend its gains versus other currencies, not just the yen. And moving on to the dollar-yen pair, we can see here it has made decent progress, having touched the 4.5 months low last week, dropping to around 108.27. It's currently trading around 109.70. We do have a bit of a risk off in the markets this morning, with equities in Asia down following a mixed performance by US indices yesterday. The Bank of Japan did have to step in its bond buying operation to offer an unlimited amount of 10-year Japanese government bonds to keep the yields near its 0% target. So the fact that the global bond yields are going up suddenly so fast is actually causing some panic among investors, particularly in the equities market. Despite that, though, the yen is broadly weaker this morning, not being able to benefit from that slight risk off we're seeing this morning. And dollar yen is on track to gain 1% this week, although it did fall by around 3% versus the yen in January as a whole. Let's move on to the euro now. We can see the euro has been climbing higher all this week. It did cross back above the 1.25 level. That level is being tested at the moment. It's trading just below it. So the main reason for the euro's gains this week are that those expectations that the Eurozone monetary policy in the Eurozone will tighten further in 2018. Yesterday, we had a strong set of manufacturing PMIs, the final readings for January, all of which boosted expectations that the Eurozone, boosted the outlook rather for the Eurozone economy. We are hearing some mixed signals from the European Central Bank. Its chief economist, Peter Pryat, yesterday said that there's an ample degree of monetary stimulus that remains necessary. On the other hand, Nowotny did say that the bond buying program should stop now. So all of that isn't really helping in terms of keeping upside pressure, keeping down upside pressure on the euro, and it's a fairly similar story for the pound. It's those expectations that the Bank of England will raise rates further in 2018, narrowing the monetary policy divergence between the UK and the US. We can see sterling has been a pretty rocky ride up for the pound in the past week, but it did manage to climb back above the 1.42 level. It's slightly off its highs late yesterday, but still comfortably above the 1.42 level. The UK manufacturing PMI yesterday disappointed for January, but we have had some easing of the political uncertainty surrounding May's government, as well as growing expectations that the Bank of England could potentially raise interest rates as early as May. The Bank of England holds its first policy meeting of the year next Thursday on February the 8th, and it could potentially give some signals then as to whether or not interest rates could be going up as early as May. Moving on to the Australian and New Zealand dollars now, we can see the Aussie has been steadily drifting lower. It actually breached below the 0.80 level versus the greenback a short while ago, and that's mainly due to the recent set of weak data out of Australia. We had disappointing inflation numbers as well as a plunge in building approvals yesterday. We did see a slight pickup in producer prices in the fourth quarter from the data released earlier today out of Australia, but overall the main focus for investors is the declining yield spread between the Aussie and the US dollar. It's a similar story for the New Zealand dollar as well, although overall the New Zealand dollar has managed to hold fairly firm versus the greenback this week. We can see the Kiwi is currently trading around 0.7350 at the moment, having dipped below the 0.74 level from earlier during the week. It is finding support from better than expected consumer confidence data out of New Zealand. The focus for both currencies next week is the monetary policy meeting by the Reserve Bank of Australia and the Reserve Bank of New Zealand, both of which hold their first policy meetings of the year in the coming week. And a quick look at today's economic calendar. We can see UK construction PMI is coming up shortly, as well as Eurozone producer prices, but the main focus will be non-farm payrolls report. That's due at 13:30 GMT. And we're also going to have the final reading of the University of Michigan Consumer Sentiment Index and factory orders, and a speech by San Francisco Fed President John Williams at 19:30 GMT. That's it from me. Thank you very much for watching, and have a great day.